The concept of a global economy appears more feasible than ever before. However, an increasing number of individual economies are facing isolated breakdowns, endangering the lives of millions of people. This trend is primarily observed in developing economies, with several other countries experiencing similar breakdowns at different stages. It is crucial to comprehend the reason behind this phenomenon, which is happening currently rather than a few years ago, when the global economy was apparently in a worse condition. In today's video, we try to answer what is causing numerous economies to collapse at present. Are there any shared issues that lead to these failures? Furthermore, can economists prevent such issues to mitigate the damage to other economies? Risk of economic breakdowns in developing economies. Developing economies are more prone to national economic breakdowns than undeveloped or advanced economies because the latter have inherent advantages. Undeveloped economies, on the other hand, are perpetually in a state of economic failure, and their economic output is mainly informal. People in such countries lead independent lives that are less dependent on the market compared to individuals in most other parts of the world. In regional areas of these countries, the population lives on meager amounts, often less than $2 a day. Nevertheless, they manage to survive by growing and collecting their food, constructing their shelter, and providing services to one another in small communities. In such areas, there is no requirement for money as a formal medium of exchange. In both developing and advanced economies, a significant portion of people's labor is allocated towards producing market-oriented output rather than for personal use. This is generally beneficial, since it allows individuals to specialize in a particular task and increase overall productivity. However, it also implies a greater dependence on the market and reduced ability to produce everything independently, as observed in undeveloped economies. To be clear, life in these countries is far from easy or prosperous. However, if the recorded economic output in these economies declines by 20% in a year, the average person's quality of life would not be as severely affected compared to an economy where people dedicate most of their labor towards producing market-oriented output. In such economies, the market supplies almost everything required for survival. Several economic collapses have begun, with developing countries experiencing temporary disruptions to their access to the US dollars, which can occur due to a slowdown in trade, or US-based institutions retracting their investments to focus on their domestic economy. Presently, this situation is being witnessed worldwide due to higher interest rates and greater uncertainty about the economic future of weaker countries. In such a scenario, multinational corporations are less likely to risk investing their money in developing countries that may potentially become the next Sri Lanka. They may instead choose to invest in government treasuries, which offer high yields with little to no risk. This situation also exerts pressure on developing economies as their governments must offer even higher rates on their bonds to compensate investors for the risk of not investing in domestic treasuries, where repayment is almost guaranteed. As an example, Sri Lanka is currently offering a 24.4% interest rate on their 10-year government bonds, which still may not be sufficient for most investors. This has significant implications because it undermines the role of governments in promoting economic growth. The relationship between economic growth and effective governance. Effective government is crucial for any economy, and one of the most critical roles is to provide infrastructure necessary for industries to operate. This includes essential infrastructure such as shipping ports, airports, roads, phone and internet networks, education, and healthcare. Without these utilities, no industry would be able to operate competitively. Investing in infrastructure is essential for the existence of industries in any economy. Although these utilities can eventually be privatized, it is initially the government's responsibility to build them. Good infrastructure spending can lead to economic growth, which generates additional tax revenue for the government to repay the loans used to fund the infrastructure. Regrettably, most governments cannot simply print money to finance infrastructure projects, as these typically involve large international companies that will not accept payment in the currency of the developing country that lacks any significant value-producing capability. Instead, they would require a world reserve currency, such as the US dollar, the euro, or increasingly, the Chinese RMB, if the overseeing construction company is Chinese. China, an investor or a debt collector? Over the past decade, China has been a significant investor in developing countries, primarily through its Belt and Road Initiative. Through this initiative, China has offered inexpensive loans to undeveloped and developing economies to build infrastructure projects that would connect them to the trade network being developed in the region. Developing countries welcomed China's Belt and Road Initiative, which involved providing cheap loans for infrastructure projects that opened them up to China's expanding trade network. However, China demanded loan repayment, even at low interest rates, and had control over what was built. China favored infrastructure that would benefit its own trade interests, even if it wasn't the most profitable investment for the countries involved. Currently, China has ceased its lending program and has transitioned into becoming a global debt collector, attempting to retrieve money from economies that are struggling to pay back their loans despite the generous terms. This shift has transformed China from a net capital provider to a net capital recipient, adding to the burden on developing countries worldwide to source enough money to repay the loans. The power of democracy. In today's global economic climate, it's impossible for any single country, especially a small developing one, to exert control over external factors like China's foreign policy or the decisions made by reserve banks. However, governments can still exercise control over which projects are accepted or rejected, which is a challenging task. Fortunately, the 1993 Nobel Prize Economic Sciences was awarded to economists Douglas North and Robert Fogel for their solution to this problem, which involves the power of democracy. A vast majority of modern advanced economies are functioning democracies, with oil-rich states being the only exception. Fogel and North were esteemed economic historians who studied the aftermath of the European revolutions that removed monarchs and instituted systems of representative government. These governments favored the growth of merchant classes, ultimately paving the way for the Industrial Revolution and the current state of the modern world. The existence of democracies, which allow citizens to vote for policymakers, means that decisions must serve the will of the people. This increases the likelihood of being voted out in the next election if bad decisions are made. This motivated government leaders to provide services that not only mandated order, but also gave citizens the tool to develop industries and create opportunities for more potential voters. Today, major economic decisions in advanced economies involve extensive consultations with voters on the complex details of a plan. While individuals tend to disregard most governmental actions, they can still exert influence if implementation is flawed or if there are direct externalities. Public projects carried out by non-accountable governments are usually executed with less care, despite their good intentions of offering valuable public services or economic capabilities. Mismanagement can occur even in highly representative democracies, but such issues are usually resolved in the following election. Therefore, governments usually prefer a gradual and cautious approach to implementing policies. The majority of nations participating in the Belt and Road Initiative lacked robust democratic systems. Consequently, the level of consultation and thoughtful consideration before agreeing to deals was significantly lower. Even within China, where smaller government ministries can authorize large initiatives, numerous projects have been approved that ultimately result in wasteful expenditure, achieving little to no progress. These underlying reasons are the fundamental causes of failure, particularly in developing economies. However, the question still remains as to why these nations are currently experiencing these failures. Why are developing countries failing? The institutions that led billions of dollars to governments globally to support economic development are not naive. They carefully assess the risks before loaning money to any economy, and they only do so if they believe that they will be repaid. However, inadequate economic management, poor investments, and corruption can render national economies vulnerable, leading to slower economic growth. Although these factors alone might not cause a complete economic collapse, they can put governments in situations where they are unable to repay their loans. Therefore, lenders typically limit the amount they loan to minimize the risk of non-payment. According to some economists, leaders limit the amount of money they provide to countries. However, this view assumes that everything remains static, even when countries have a substantial debt and make poor economic decisions. However, just like a fire, an economic collapse requires fuel and oxygen. Most importantly, it needs a spark to ignite. The spark in this case is an economic shock, which can be broadly classified into two types: supply shocks and demand shocks. Economic shocks are unexpected changes in market forces. For instance, a supply shock could result from an industrial area being hit by an earthquake that destroys all the factories. This would lead to a rapid and unexpected drop in the supply of goods in the economy, causing significant issues, especially if the country had existing economic vulnerabilities. On the other hand, a demand shock occurs when the entire population reacts to a terrible news story, causing them to be afraid and unwilling to spend money. People become more concerned about saving money and ensuring their security in case things get wrong. Consequently, businesses find it difficult to sell their goods and services, leading to a decline in their revenue and an inability to hire staff. This scenario leads to rising unemployment and stresses the economy, putting pressure on any existing weaknesses. Economic shocks can also result from an unexpected increase in supply or demand, which may be beneficial in the long term, but can still put pressure on economic systems in the short term. For instance, if tomorrow someone invented a new, more efficient way of building houses on the same amount of land, the supply of housing would triple, leading to a drop in housing prices and knock-on effects throughout the entire economy. In the long term, a greater supply of housing would be beneficial, but it would cause short-term problems. The economic shocks of the past 3 years have been evident, and the global pandemic and the economic response to it can be likened to a lightning strike. However, economic collapses take time to happen as countries negotiate their debt and seek assistance from international organizations like the IMF and the World Bank. These organizations try to prevent economic failures from spreading to other countries. Unfortunately, there is a high possibility that we will witness more national economic crises over the next few years as the world recalibrates from a bumpy start to a new decade. Even though many challenges will have a net positive impact going forward and the world will continue to be more economically prosperous, the growth will still benefit some more than others, as has always been the case. What do you think? Will the world economy finally start to get back on its feet anytime soon? Leave your thoughts in the comment section below. Thank you so much for watching. If you haven't already, click the like button, subscribe to the channel, and turn on notifications to stay up to date with our latest uploads.